My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject Financial Management as prescribed by JNTU and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2 first important short question is: define capital budgeting. Why is it important? Capital budgeting definition and importance. Capital budgeting is the process of planning and deciding about long-term investments of a company. These are big financial decisions like buying new machinery, setting up a factory, launching a new product, or expanding into new markets. Since these projects need huge money and affect the future of the company, careful study is necessary before investing. It is important because once money is invested, it cannot be easily taken back. A wrong project may bring losses for many years, while the right project can increase profits, growth, and shareholder wealth. Example: suppose Tata Steel wants to build a new steel plant. Before spending crores of rupees, it must study costs, future demand, and expected profits. This careful study is capital budgeting. In short, capital budgeting helps managers answer the question, should we invest or not? It ensures money is used wisely, risks are reduced, and the company grows in the right direction. Next important short question is: 2. Developing cash flow. Developing cash flow. In capital budgeting, developing cash flow means preparing a clear picture of all money that will come in, inflows, and go out, outflows, during the life of a project. It is like making a financial roadmap of the project from start to finish. Cash inflows include revenues from sales, savings in costs, or any other benefits the project gives. Cash outflows include the cost of machinery, construction, raw materials, salaries, maintenance, and taxes. Example: suppose Infosys invests 40 lakhs rupees in a new software project. This amount is the initial outflow. The project then generates 12 lakhs rupees every year for 5 years as revenue inflows. By writing down all inflows and outflows year by year, managers can calculate profit and check if the project is worth investing in. In short, developing cash flow is the foundation of investment decision-making. Without accurate cash flow estimates, no method like NPV or IRR can guide correctly. It ensures safe and profitable investments. Next important short question is: 3. Data for new projects. Data for new projects. Before starting a new project, a company needs the right data to make correct investment decisions. This data is like the raw material for capital budgeting. Without it, managers cannot judge whether the project will succeed or fail. The important data includes initial investment, cost of land, building, machinery, etc. Operating costs, expenses on salaries, raw materials, power, and maintenance. Expected revenues, income from sales or services. Project life, how many years the project will run. Taxes, depreciation and salvage value, government taxes, reduction in asset value, and resale value at the end. Example: if Reliance Jio plans to launch a new 5G tower network, it must collect data about land cost, equipment, spectrum fees, operating charges, customer demand, and future profits. In short, correct data for new projects helps in estimating cash flows, reducing risks, and selecting the most profitable project for the company's growth. Next important short question is: 4. Approaches for reconciliation. In capital budgeting, sometimes different evaluation methods like NPV, net present value, and IRR internal rate of return, give opposite results. This creates confusion for managers in selecting the right project. To solve this, companies use certain approaches for reconciliation. The main approaches are 1. Modified internal rate of return, MIR. It improves the IRR method by assuming reinvestment of cash inflows at the company's cost of capital, making results more realistic. 2. Giving priority to NPV. Most experts prefer NPV because it directly shows the actual profit in rupee terms, while IRR only gives a percentage. Example: suppose project A has NPV of 50,000 rupees and IRR of 14%, while project B has NPV of 30,000 rupees and IRR of 18%. IRR suggests project B, but NPV suggests project A. By reconciliation, managers usually choose project A as it adds more money to shareholders' wealth. In short, reconciliation ensures correct decisions and avoids confusion. Next important short question is 5. What is marginal cost of capital? The marginal cost of capital, MCC, is the extra cost a company has to pay when it raises additional funds for new projects. It shows the cost of arranging one more rupee of capital through equity, debt, or preference shares. Usually, the first funds are cheaper, but as the company needs more, lenders and investors may demand higher returns because the risk increases. That is why the marginal cost of capital is often higher than the average cost. Example: suppose Infosys borrows 100 crores rupees at 10% interest. Later, if it wants another 50 crores rupees, banks may charge 12% due to higher risk. This extra 2% reflects the marginal cost of capital. In capital budgeting, MCC is very important. A project should be accepted only if its return is greater than MCC. If the project earns less than this cost, it will reduce shareholder wealth. In short, MCC helps managers make safe and profitable investment decisions. Next Unit 2. Long questions. First important long question is: explain the investment decision process. What are the stages of project generation, evaluation, selection, and implementation? Investment decision process. The investment decision process in financial management is the method by which a company decides where to invest its money for long-term growth. Since these projects involve huge funds and risks, managers carefully move step by step before making a decision. The process has 4 main stages. 1. Project generation. This is the stage where new ideas for investment are created. Ideas may come from employees, managers, market research, or competitors. Example: Tata Motors generating an idea to launch a new electric vehicle. 2. Project evaluation. Here, the company studies each project idea in detail. It calculates the expected costs, revenues, profits, and risks. Different capital budgeting techniques like NPV, IRR, and payback period are used to check if the project is financially sound. Example: estimating how much the electric vehicle will cost, expected sales, and profits in future. 3. Project selection. After evaluation, the best project is selected. The company chooses the project that provides the highest returns and matches its long-term goals. Sometimes, more than one project may be chosen if funds allow. Example: Tata Motors selecting the electric vehicle project because it shows higher profits than other options like launching a diesel SUV. 4. Project implementation. Once the project is selected, the plan is put into action. This involves arranging funds, purchasing machinery, hiring staff, and starting production. Proper monitoring and control are also needed to avoid delays and cost overruns. Example, Tata Motors setting up a new plant, buying machinery, and starting production of the electric car. Conclusion. In short, the investment decision process is like a journey, idea, study, choose, implement. If done carefully, it ensures that money is invested in the right project, risks are reduced, and the company achieves growth and success in the long run. Next important long question is to discuss in detail the traditional and discounted cash flow (DCF) methods of capital budgeting. Traditional and discounted cash flow (DCF) methods of capital budgeting. Capital budgeting techniques are tools that help managers decide whether to accept or reject a project. These techniques are divided into traditional methods and discounted cash flow (DCF) methods. 1. Traditional methods. These methods are simple and do not consider the time value of money, the fact that 1 rupee today is worth more than 1 rupee tomorrow. Payback period (PBP). It tells how many years a project will take to recover its initial investment. Example, if a machine costs 5 lakhs rupees and generates 1 lakh rupee per year, the payback period is 5 years. Easy to calculate. Ignores profits after recovery and time value of money. Accounting rate of return (ARR). It measures average accounting profit from a project compared to its investment. Example. If a project gives 50,000 rupee average profit and costs 5 lakhs rupees, then ARR is equal to 10%. Simple, based on profits. Ignores cash flows and time value. 2. Discounted cash flow (DCF) methods. These methods are more scientific because they consider time value of money by discounting future cash flows. Net present value (NPV). NPV is the difference between the present value of inflows and outflows. If NPV 0, project is accepted. Example, a project costing 1 lakh rupees with PV of inflows 1,20,000 rupees, NPV is equal to 20,000 rupees, accept. Internal rate of return (IRR). IRR is the rate at which NPV becomes 0. If IRR is higher than the cost of capital, the project is accepted. Example, if a project has IRR of 14% and cost of capital is 10%, it should be accepted. Conclusion. Traditional methods are easy but less reliable. DCF methods are accurate because they include time value of money and future risks. Thus, in modern financial management, NPV and IRR are preferred for making better investment decisions. Next important long question is 3. Explain the NPV versus IRR debate. How can differences between them be reconciled? NPV versus IRR debate. In capital budgeting, two popular methods are net present value (NPV) and internal rate of return (IRR). Both are widely used, but sometimes they give different answers, creating a debate. 1. What is NPV? NPV is the difference between the present value of inflows and outflows. It shows the actual profit in rupee terms. Example, if a project costs 1 lakh rupees and the PV of inflows is 1,20,000 rupees, then NPV is equal to 20,000 rupees. Since NPV is positive, the project is accepted. 2. What is IRR? IRR is the discount rate at which NPV becomes 0. It shows the rate of return a project is expected to earn. Example, if a project has IRR is equal to 15% and the cost of capital is 10%, it is accepted. 3. Why the debate? Ranking problem. When two projects are compared, NPV may suggest project A, but IRR may suggest project B. Scale of investment. NPV favors large projects because it shows absolute profit, while IRR favors smaller but more efficient projects because it shows percentage return. Reinvestment assumption. NPV assumes cash inflows are reinvested at the cost of capital, while IRR assumes reinvestment at the project's own IRR, which may not be realistic. 4. How to reconcile the differences? Use modified IRR. Merit assumes reinvestment at the cost of capital and gives more realistic results. Give priority to NPV. Since it shows actual wealth in rupees, most financial experts prefer NPV over IRR for final decisions. Example, if project A has NPV 50,000 rupees and IRR 14%, while project B has NPV 30,000 rupees and IRR 18%, NPV suggests A, IRR suggests B. By reconciliation, the company usually chooses project A because it adds more money to shareholders' wealth. Conclusion. The NPV versus IRR debate happens because of different assumptions. But in practice, NPV is considered superior since it directly measures wealth creation, while IRR can be used as a supportive tool. Next important long question is: 4. What is cost of capital? Explain its types and methods of measurement. Cost of capital meaning, types, and measurement. The cost of capital means the minimum return a company must earn from its investment projects to satisfy investors and lenders. In simple words, it is the price the company pays for using other people's money. If returns are below this cost, the company loses value. Types of cost of capital. 1. Cost of debt. It is the interest paid on borrowed money. Example, if a company takes a 1 crore rupees loan at 10% interest, the cost of debt is 10% adjusted for tax benefits. 2. Cost of equity. It is the return expected by shareholders for investing in the company's shares. Shareholders take more risk, so their expected return is usually higher. Example, if investors expect a 12% return on shares, that is the cost of equity. 3. Cost of preference capital. It is the fixed dividend payable on preference shares. Example, a 9% preference share means cost of preference capital is 9%. 4. Weighted average cost of capital, WACC. Since companies use a mix of debt, equity, and preference shares, WACC calculates the overall cost by taking weights of each source. Methods of measurement. Debt, interest rate times 1 tax rate. Equity. Dividend discount model, DDM cost of equity is equal to dividend price plus growth rate. Cap model, cost of equity is equal to risk-free rate plus beta times market return risk-free rate. Preference capital, dividend divided by price of share. WACC formula. WACC is equal to WD times KD plus B times K plus WP times KP, where W is equal to weights, K is equal to cost of each source. Example, if a company finances with 50% equity, K is equal to 12% and 50% debt, KD is equal to 8% after tax, then WACC is equal to 0.5 by 12% plus 0.5 by 8% is equal to 10%. Conclusion. Cost of capital is like the hurdle rate for projects. If a project earns more than this cost, it is good. If less, it should be rejected. It ensures funds are used wisely and investors remain satisfied. Next important long question is: 5. What is weighted average cost of capital, WACC? How is it calculated and why is it important in capital budgeting decisions? Weighted average cost of capital WACC. The weighted average cost of capital WACC is the overall average cost a company pays for using funds from different sources like equity, debt, and preference shares. Since most companies do not rely on just one source of money, WACC combines all costs in proportion weights to their use. How is WACC calculated? The formula is WACC is equal to V times K plus WD times KD times 1 tax plus WP times KP, where WP is equal to proportion, weight of equity, debt, and preference capital. KD, KP is equal to cost of equity, debt, and preference capital. Example, a company raises money as follows. 50% equity, K is equal to 12%. 30% debt, KD is equal to 10%, tax rate is equal to 30%. 20% preference shares, KP is equal to 9%. WACC is equal to 0.5 by 12% plus 0.3 by 10% times 0.7 plus 0.2 by 9% is equal to 6% plus 2.1% plus 1.8% equals 9.9%. So, the company must earn at least 9% return on its projects. Why is WACC important in capital budgeting? 1. Decision benchmark, hurdle rate. WACC acts as the minimum required return. If a project's return WACC, accept it, otherwise reject. 2. Risk and return balance. It reflects the combined risk of debt, low cost, but risky if overused, and equity, expensive, but safer. 3. Wealth maximization. By comparing project returns with WACC, managers ensure only profitable projects are chosen, increasing shareholders' wealth. Conclusion. WACC is like a thermometer of capital cost. It tells how hot, expensive, or cool, cheap a company's funds are. In capital budgeting, it is the cut-off rate. Only projects giving more than WACC should be selected, ensuring long-term growth and financial health.